Welcome. This is Axel Merk, President and Chief Investment Officer of Merk Investments. I'm here to give you my in-between-the-line readings. As you are aware, Nick Rees, our Senior Financial Analyst, is providing these chart books with his concise analysis. I try to go beyond the analysis and give some interpretation. And with that, let me go through these charts, and I'm not going to focus on each chart as long as Nick usually does. His comments are below the written ones he's provided. And so the first chart most of you are aware of is the whole essence behind why one looks at the business cycle. Historically, the equity markets performs better during economic expansions. There are some notable exceptions. I tend to point out the 1987 crash. It goes really beyond it, though, because there are other things that happen during recessions, most notably interest rates change as well. We happen to believe that there is a insufficient pricing of declines in interest rates at the peak of the economic cycle. And as we may be approaching that, it warrants paying close attention to that. We have some ideas what one can do about that. Please get in touch with us to discuss that further. But for the time being, the leading economic indicators show that the expansion is ongoing. Tad of a kind of a slowdown as far as the rate of expansion here, according to leading economic indicators, are concerned. The steepness or the decline of the steepness in the yield curve has been in the news quite extensively. Lots of folks pointing out that as the short-term rates have been moving higher, with long-term rates being reasonably the same, we have a flattening of the yield curve, and should we get an inversion of the yield curve, that would be an indication of a potentially looming recession. Here you see the longer-term context of how this actually plays out. As we tend to point out, and please read our May Merk Insight available on our website for a more extensive analysis of this, we've had a flattening of the yield curve for years now. Now, clearly, as we get towards a potential inversion of the yield curve, meaning short-term rates being higher than long-term rates, we might be getting closer to the end of the economic cycle. Very much agree to that. But also keep in mind the context here. The reason the Fed is hiking rates, the reason is mostly due to the fact that inflationary pressures might be rising. And that's where I try to kind of think about, well, how are these pressures going to play out? And in that context, yes, looking at the other indicators on the business cycle is relevant. The PMIs, the Purchasing Managers' Index, is doing just fine in the U.S., continues to expand. A lot has been said about a potential slowdown globally. And the blue line there on top is Germany, that's been coming down. A note above 50 signals expansion. When I talk to folks back in Europe, Germany in particular, the economy seems to be doing quite well, although everybody is concerned about the potential trade war. German car manufacturers, for example, are affected, notably with their exports from the U.S., where they manufacture cars, to China. So there's just an announcement by one of the German manufacturers that they're going to build more in China. And so there's more local production happening. But also, this is just one of the indicators. There are several other indicators as well. Industrial production in Germany was just better than expected. And then conversely, there is an indicator called ZEW that was worse than expected, although that ZEW indicator is really a subjective soft data point where so-called experts give their own prediction, and obviously they're influenced by the negative tariff talk. And so any of these indicators have to take a little bit with a grain of salt because they all look at a little slice of the market. I happen to believe that the negative interest rates in Europe continue to be highly expansionary. And yes, there are obviously some headwinds, but net, things are moving along throughout the world, with obviously some exceptions there. Russia and Brazil are below 50 here on that scale. Unemployment, much has been said about unemployment ticking up because more people are joining the workforce. This is where I like to draw parallels to the Fed book that we have. If you haven't looked at that, please look at that. It's fascinating. If you're love monetary policy. But the reason we love the Fed chart book is because together with the business cycle, I believe, it gives one an image, an impression as to how inflationary pressures are evolving. When I look at this chart, I'm reminded of a chart in the Fed chart book where we look at the labor participation rate, most notably the male labor participation rate, and of the prime age workers. And the question is how many more can come into the labor force. Now, clearly, a lot of people have been coming in, but in what time will we exhaust that pool? And of course, conversely, how prudent is it for the Federal Reserve to wait until that pool is exhausted? If I look at a bunch of things happening, I happen to think we are moving towards an overheating economy. Aside from the Fed potentially dampening it, our president might be dampening it with a trade war, but we do have that economic stimulus as well. My baseline scenario is that this economy will show increasing signs of the overheating, and that will cause the Fed to continue to tighten even as this economy might be slowing down at some point. And that's why we're going to see this inversion of the yield curve that we saw earlier, that will have to come from the Fed's point of view because they're concerned about inflation moving higher. Oops, here we go. There we have the next chart. There are some models here on U3. I'll just leave it up to Nick as to what he discussed in his talk on that. Here again, a chart on the potential output gap. That is another sign that we might be coming closer to an overheating economy. Growth seems to be doing just fine. The credit cycle, lower lines mean things are good, so to speak. Consumers are good, and in that context, consumer confidence is good, and lending standards are also fairly easy, so to speak. And the relevance here is that in an advanced stage of an economy, banks love to give a loan because they want to participate in the Goldilocks economy. And that is precisely while the Federal Reserve continues to hike rates, because the whole point of hiking rates is to tame an economic expansion. Now, they don't want to kill it, but they want to tame it. And of course, as the economy continues to do well, credit is abundantly available. They have to gradually push on the brakes so that this thing doesn't overheat. And my take is that the reluctance they have shown causes the economy to continue to steam ahead. Lending standards continue to be easy, and in this context, again, we have the ingredients for potential overheating in the economy. Now, if you're looking for stress in the market, you're not going to find it in this high yield spread chart. Those are the so-called junk bonds. There is stress in the market, but not in this segment. We have seen some stress. We don't show it here in the bottom end of the investment grade market. And my take on that is that people are chasing yields, so they're more than happy to buy junk at a very low rate. But in the investment grade bucket, you have a different type of investor. You have an investor that might as well be very happy buying a treasury bill or some higher grade corporate bonds. They're not willing to take on the added risk for the lower end of the investment grade, because then they might as well go to the high yield space. And so we might not see all the kind of simmering stress that might be happening in some of the market, but clearly the high yield market shows very little sign of stress. So net, I agree with Nick's assessment here that framework is generally positive. There are signs of potential overheating. My take is that the signs of overheating are to be taken seriously. And what does it mean for investors, which is ultimately, of course, the question. To me, on the one hand, if your view is you invest in the stock market during expansions and you're out of the stock market during recessions, then obviously the stock market might be the right place to be. We don't give specific investment advice here. And my own take is that, and we have that on the market chart book as well, is that given where we are historically, the returns over the next 10 years or so might be most modest. Now, that doesn't mean you need to hunker down, but it might mean that you may want to look to add alternative ways of adding something to a portfolio. And if you're not comfortable with these valuations and where we are, there is absolutely nothing wrong with taking chips off the table. very few people are able to time the top exactly. As I alluded to earlier, we do a lot of work on interest rates these days, and believe that at the peak of the economic cycle, the rate cuts that will follow are underpriced into the market, and there might be some opportunities to be able to take advantage of. So please do get in touch with us if you want to learn more about that. And with that, I wrap it up and talk to you next time.